Money Talks.
Money Talk.
Money Talks. Money Talks.
Hi, my name is Ibukun Oyedeji, President CFA Society Nigeria. Join me and a host of other financial industry practitioners for Money Talks with CFA Society Nigeria.
Money Talks.
Money Talk.
Money Talks. Money Talks.
Money Talks with CFA Society Nigeria. Let's talk about money.
Hello everyone and welcome to Money Talks. Money Talks is brought to you by CFA Society Nigeria and is a financial literacy program. Smart. Uzechi is my name. You can call me Captain Smart and you'll be financially correct. Today on the show, Babangida Yahaya is my guest. He's a seasoned financial services professional with over 18 years of extensive experience spanning banking and capital markets. As the head of depository services at Central Securities Clearing System PLC, that you otherwise know as CSCS, he plays a pivotal role in driving strategic initiatives that enhance market efficiency and investor confidence. Beyond his professional accomplishments, Babangida is a certified trainer and an active participant in mentoring programs where he shares his wealth of knowledge and experience with the next generation of industry leaders. His leadership, strategic insight, and commitment to excellence continue to make a significant impact on the financial ecosystem. Babangida Yahaya is here with me and we'll be talking this evening with him about understanding how payment in the capital market works. And as you know, we usually welcome our guests in a very special way, and Babangida will not be an exception this evening. So let's do this to welcome him this evening. Ladies and gentlemen, Babangida Yahaya is with us. So Babangida, as to say, welcome to Money Talks. This is your first time, right? Good evening to you. How are you doing?
I'm very well, thank you.
I can see that you are the replica of the CFA person, so it's good to have you. How's work, by the way?
Work as well. Everything is fine.
Good. All right. Together, we're discussing understanding how payment in the capital market works. You can join the conversation anytime. You can call us on the telephone number 0700 923 923 923. That's 0700 923 923 923. You can also call us on 0705 161 7536. That's 0705 161 7536. You can call 0201 277 1923. You can also send us messages on WhatsApp 0817 313 6193, or go to the social media handles of CFA Society Nigeria, beginning from the website www.cfasocietyng.org, or you can go across social media: Facebook, LinkedIn, YouTube, and even on X, CFA Society NG. That's where to find and continue the conversation from there, even when we have left the studio. So Babangida, once again, it's good to have you. Let's begin the conversation this evening. We're talking about this particular subject, is one that I am even interested in: how to do payments in the capital market, how it works. A lot of people don't even know the difference between capital market and money market. So let's start from there. What exactly is a capital market? And when some people say money market, how do you differentiate both markets?
Good evening again, Captain Smart.
Yeah.
Thank you very much for having me. It's absolutely an absolute pleasure to be here this evening in the studio. And just before I delve into that question, let me start by bringing you good tidings from the Central Securities Clearing System, CSCS. And of course, to also congratulate the CFA Society on the recent election of new officers into key roles to steer the affairs of the society, perhaps for the next few years. And to also commend, of course, Inspiration FM and the CFA Society for very laudable initiatives such as what you have on this program, targeted at promoting financial literacy within this space. I think it's very relevant for our market, and it comes with significant benefits. So I'll just delve very quickly into the question. what exactly is capital market and how does it differ from the money market? In addressing this, I would like to approach it a bit differently because I reckon that the focus is on capital market, but in relation to money market. So perhaps what I would do is to attempt to define what the two markets are and perhaps touch on some similarities between both markets. I will then go on to highlight the key distinction between the capital market and the money market. I believe that with this approach, it also laid the context for further conversations that we'll be having within the course of this program. So what these markets are essentially, be it money market or capital market, you can think of them as a very crucial component of the financial system that facilitates the flow of funds between investors and borrowers. In essence, you have the investors who have surplus of funds, and you have borrowers who are looking to borrow these funds, of course, to undertake perhaps certain projects, or as the case may be. In terms of similarities, what you do have is that, of course, in these two markets, it facilitates fund mobilization, as I have rightly highlighted. It provides an avenue for the entities with surplus to provide the entities with deficit. Also, in terms of similarity, what you have with these two markets is that there's an involvement of what I would say financial instruments of various kinds. You do have in these two markets different types of financial securities that trade on the market, much as they may be different, across both markets. Of course, in terms of economic contribution, you do, by the mere fact that these markets provide an avenue for liquidity and investment opportunities, you can then see the nexus, or if I may say, the direct connection between how these funds flow, and of course, how they support in expanding businesses, and also support the governments in undertaking crucial developmental projects, as it were. I would also say that in both markets, what you will find is the presence of financial authorities who act as regulators in both markets. These markets are highly regulated, right? Because again, the key goal of every regulator in every market, the primary focus is on investor protection, to ensure that every investor is duly protected. And that's why in this market you don't find the likes of right? Because they're subject to very stiff regulations and all of that. And perhaps lastly, I would say that both markets provide an avenue for not only individual investors but also institutional investors to participate in one form or the other. Having touched on the similarities, what then is the key difference? What is the capital market? In essence, the capital market is a financial market for long-term financing and investment opportunities. Whereas, on the other hand, the money market is also a financial market for short-term liquidity needs, if I may put it that way. So the key distinction is on short-term and long-term. And contextually, if we talk about short-term, we're essentially referring to a period of 1 year or less. So in essence, the capital market, of course, is you have a lot of participants in the capital market, every participant playing distinctive roles to bring that stability to the market. Talk about the exchanges, talk about the registrars, talk about issuing houses, talk about the brokers, talk about the regulators, and of course talk about the CSDs, which is the Central Securities Depository. As you know, the CSCS is the premier financial market infrastructure for the capital market, and we are a Central Securities Depository. So I'll keep it at that.
Okay, so we're just looking at short term, long term. Both of them, investment is the common denominator there. All right, so let's stay with the capital market now. Babangida, you have to tell us the role that the capital market actually plays in the overall economy, talking about investment and its landscape?
Okay, so I'll just start by saying that I have rightly highlighted earlier that the capital market essentially provides a channel for the flow of funds between investors and entities who are looking to raise such funds. Of course, in so many ways they contribute to the overall economy and investment landscape. And I'll just perhaps say that start by saying that if we look at it from the perspective of how it facilitates capital formation, it is only because you do have a capital market that businesses are able to come to this market to raise long-term financing by either issuing stocks. In the case of governments, they issue bonds to investors to be able to raise capital. Of course, I did mention the governments also play heavily in this market. They come and raise funds. For those of us who are quite familiar with Victoria Island, if you're heading towards Modibello from CMS, right, you'll see that road has been rehabilitated.
Yeah.
And there's a signage there that indicates that the project was funded with the Sukuk bonds. Yes, and a couple of other examples. If you're traveling by road to Benin, you would also see that a key part of that road was actually rehabilitated with the funds that was raised from the issuance of the Sukuk. So that's what it does. It also encourages investment and savings because, of course, for investors who have funds and looking to invest in the market, they are doing this with the expectation of getting returns on their investment. And one of the ways, or some ways in which these investors actually get returns on their investment, is by way of dividends, right? In the case of equities, if they invested in equities, or even interest on bonds, which is typically paid as coupon payments, or you have capital gains, right? Also, you can look at it from the perspective of enhancing liquidity, because within the capital market, you do have the secondary market where buyers and sellers can, of course, buy and sell securities that have previously been issued. And what you then have in this situation is that it promotes a lot of efficiency within the market, even from the perspective of price to discovery, and all of that, and also boosts liquidity by the mere virtue of that trading that goes on, buy and sell that goes on within the market. From the economic growth perspective, like I did mention, business entities, they come here to raise money. What do they do with it? They use it to undertake some projects. In some cases, they use it to expand their operations. And there's a multiplier effect that comes with it, because in doing so, it also creates opportunities for new jobs, right? And as people look, or rather people fill these rules, they get paid salaries, wages, and the likes. So you have that constant flow of funds into the system. And of course, there's also the impact on productivity, which contributes largely to our GT growth. I mean, I can go on and on,
Yeah.
But I think I'll just keep it at that.
Okay, let's talk about how money works, or how money flows in this market. The flow of money, and when investors buy and sell securities, like you talked about bonds right now. In case of stocks and bonds, how does it work?
Okay, so just before I answer this directly, I would like to highlight the two main markets in the capital market, which is essentially the primary market and the secondary market. I think I touched on it earlier, and I would like for us to look at it from these two perspectives, because I had mentioned earlier the primary market is a market where investors buy newly issued securities, right? Be it in the form of equities or bonds, as the case may be. Whereas in the secondary market, buyers and sellers come trade already issued securities. Having said that, if we're looking at it from the primary market perspective, you have a situation where an entity, or let's say government agency or government itself, is coming to markets to raise funds, and what they then do is to issue bonds, or an entity or a corporate organization that is coming to market would typically come and list and offer equities to the market through what you call an IPO, an initial public offering. What then happens is that once that offering is made to the market, investors who are willing or interested in subscribing to the offer will do so through the issuing houses, and in the process they pay cash for what they are buying into the collection accounts of the provided by the issuing houses, right? Of course, in the end, that funds goes back to the investor for the purpose for which it was raised. Goes back to the issuer for the purpose for which it was raised in the first place. And in return for that cash that has been paid for the securities that have been bought, at some point, the investor's account will be credited with the securities that they have bought. That securities will be credited into their securities account, which typically sits with the CSDs, the Central Securities Depository. So I'm sure you must have heard things like CSCS account. CSS account is essentially an account that holds securities for investors. Think about the way you have cash in the bank, right? So this applies to securities. And in due course, the accounts will be credited. What you find is that there's been an exchange of securities, of course, that has been issued by that issuer, going to the investor who has made funds available to the issuer. And it's also a similar for the secondary market as well. If an investor if an investor seeks to invest in the secondary market, what they need to do is to go through a market intermediary, in this case a broker specifically, because by the very nature of the market structure in our own market here in Nigeria, the regulations require you to go through a market intermediary as an investor, who will then take what I would call either a sell or a buy order, right? It's either I'm selling in the secondary market or I'm buying. I give a mandate to the broker. What the broker does is to take that mandate onto the platform of the exchange, right? To go and execute the mandate. As you're aware, the exchanges are there to provide that matching. They bring buyers and sellers together, right? And once those trades are matched, they are then sent to the CSD. In this case, let me take the example of CSS as a CSD, which is also the clearinghouse and the settlement agent. It passes through a clearing and settlement process. What happens within that process is to ensure that the investor who is buying does have the funds, which will be settled to the seller at what you call the settlement date of the transaction. And of course, the seller as well, who is selling the securities, does have the securities, which will be transferred to the buyer at the end of the settlement cycle. In essence, we have the standard settlement cycle for the market. For equities, it is T plus 3, which means T is for transaction date. If I transact today, it means that plus 3 days and another 3 days, both securities and funds would settle into the respective positions of the buyer and sellers. In the case of the bonds, it's T plus 2. So, with this description, you can see how money flows from one party to the other party. Yes.
All right. I'm glad you went ahead to talk about how money flows and the key channels that you have used to make the payment. But let's talk about when things go south, because the way you're sounding, it looks like everything is just covered. There's no room for any kind of manipulation and fraud. Let's go there now. I want to take us there. Can you talk to us about the safeguards? Because money is exchanging hands here, whether it's stocks or bonds. At the end of the day, it's money that is the language that is spoken there.
Absolutely.
So what happens? How do you prevent, payment failures or fraud? Like in normal banking system, sometimes people sit in their homes and people are drawing money from their accounts. And sometimes the banks, they feign ignorance. They say, well, you quarrel with your wife or your girlfriend, so they have your PIN, they've taken your money. So let's talk about safeguards here. Do they apply in the capital market transactions?
Absolutely. And I think it's a very important question you've just raised. And I want to say to you that in the capital market, there are several safeguards in place to guard against payment failures, be it fraud, be it market manipulation. And these measures are enforced by several participants within the market, right? From regulatory bodies to the market infrastructures, talk about the exchanges, talk about the CSDs, right? And even the financial institutions, which are the settlement banks, that ultimately help in settling the cash to these investors. And you can look at it from various angles. If we're to start with the Securities and Exchange Commission, which is the overarching regulator for the market, they essentially provide the framework within which the operators, work within the market, and of course, they also provide robust rules to ensure that various players within the market, adhere to certain guidelines in terms of how they conduct their businesses. Of course, the central bank is also involved in terms of how they regulate capital flow, and the exchanges are there. They do have robust systems for monitoring transactions. There's what you call surveillance, of course, which happens electronically. They're able to, at every point in time, scan within the system and see what is going on. They can easily detect suspicious patterns, and all of that. And of course, it's very important to mention the clearing houses, in this case when it has to do with payment, bringing that assurance or confidence to the market, because the clearing houses are also there to ensure that these settlements happen seamlessly. I'm a buyer, I buy securities. On the settlement date, I want to be able to say that for a certain that my account is credited with my securities. And of course, to the seller who has sold the securities, he wants to be able to get his cash, no stories, right? And that's exactly what the clearing houses do. They are there as intermediaries between the buyers and sellers to ensure that the obligations of both parties are met, right? And of course, there are also various investor protection mechanisms to ensure that the market is safeguarded against any sort of failures, from the Investor Protection Fund to the Investment and Securities Tribunal, which is essentially a court that resolves disputes in the capital market. You also have what you call the Trade Guarantee Fund that is set up as a risk mitigation mechanism. This fund is being, of course, managed by the Central Securities Depository to always ensure that trades are settled. And perhaps I'll also touch on what you call the broker account segregation, which is essentially a structure that enforces brokers to separate funds or proceeds from their own prop trades away from that of investors. You also have the direct cash settlement, which is essentially an account setup that allows investors to receive credits directly or proceeds directly into their accounts when they. So it's a couple of robust measures by various participants, as I've tried to highlight, and I will say to you that brings a lot of confidence to the market, and it's a very important question that you asked.
Okay, finally, Babangida, we'll have just a minute and a half left on the program. I'll be glad if you can speak to this question within that time frame, and it's to ask you, how are dividends, dividends on stocks and interest on bonds paid out to investors? Because I believe when they do this business there, it's for profit. So how do they get their monies out?
Absolutely. And like I earlier highlighted, one of the ways the investors get returns on their investments, of course, is through mechanisms such as dividend payments and interest payments, like you rightly mentioned, which is essentially coupon payments. What typically happens is that dividends, of course, are paid by companies to investors from a share of their profit that they've made for a particular year. It could be paid annually. Sometimes the frequency may differ, twice in a year. And likewise, in the case of coupon payments, it's also the interest that's being paid for investing in bonds, right? Having provided liquidity for the entity. What happens is that a registrar is responsible for making these payments. When the company declares dividends is being paid, they also declare the payout, how much is being paid per share, right, in dividend payments. what the registrar does is to, of course, put together the records of these investors. They work closely with the CSDs as well to get this, fetch the records of these shareholders, and on the payment date, through the settlement banks, the dividend payments are processed. Of course, how much an investor gets will be determined by the number of shares that they hold for that particular company. And the process is not too different for the coupon payments as well. CSS is also a registrar, plays some sort of registrar role. As you're aware, the CSS is registered to the first issued domestic USD bonds that was issued by DMO sometime last year. So essentially, that's how the funds flow, or the payments are made to the investors by way of either dividends or interest payments. I mean, there's a lot more that goes on at the back in trying to smoothen out this process, but I think for the want of time, I've just tried to summarize it basically.
Absolutely. Babangida Yahaya, thank you very much for your time on the radio this evening. This has been some education. I'm very sure that some persons would like more clarifications. That's why people are just listening. So you can go to the website www.cfasociety.ng.org and get more information from there. But I must say thank you so much to Babangida Yahaya of the CSCS, who has come here this evening to educate us on the operations in the capital and money market, but essentially in the capital market. Thank you very much for your time, and we hope to see you sometime again soon.
Thank you very much, Captain Swan.
That's our show for today. Join us again next time for another edition. Till that time, keep making finance a force for good. Captain Smart is my name.
Thank you for joining us on this episode of Money Talks, hosted by the CFA Society Nigeria. Stay connected with us on Instagram, Facebook, LinkedIn, X, and YouTube at CFA Society Nigeria. Follow us for more financial insight and updates. Keep a date with us next time.